Happy holiday. And here's a video to catch you up with the material that you may have missed to get ready for the week after the holiday ends. And in this first video, we're going to look at the construction of the cash flow statement. And of the three, we've already covered the function of the balance sheet, the function of the income statement, and now we want to follow the cash in the organization, because while you're on your way to great success, if you run out of cash, it's going to kill you. It's like promising you a great meal and maybe food for the rest of your life if you can only wait 5 years. But up until then, you can't eat. Well, we know from the human experience that we all need to eat today. As a matter of fact, I'm not sure there's one person watching this video who has not already eaten today. We certainly can't wait 5 years. We die. We die on our way to success. Cash flow statement is exactly that. Do you have enough cash to get the company to the end point where you can have success in the income statement? Easy steps to put together, although it is confusing until you get these right. So you may want to watch the video a couple of times. The most complicated for most companies is the cash flow from operations. Does the operations cash actually cover the expenses, the money going out for investing and financing? Well, let's find out. First of all, did you make a profit or a deficit in your net income statement? So let's assume you made a profit. And so you see that up there, profit from operations, or just not profit altogether in your company. You bring that number down directly, and it's the first line in cash flow from operations. Because, of course, a net profit generally increases your cash. That's why companies have to, in the end, be profitable. If you're always putting cash out after a number of years, you just can't keep the company running. So we bring that profit down, put it on the first line. The second line is depreciation that we have up in the expense category. If you have it there, if you don't have it, don't worry about it. But if you have it up in the income statement, bring that down and add it back. It's positive, it's not an expense. The income statement took it out under accrual accounting, but the cash flow statement doesn't like accrual accounting. It just wants to know, where's the cash going? And since no cash went out in the income statement, in the cash flow statement, the second line says, add that depreciation back in. And then you've got 7 steps of working capital. And first I'm going to list them, mention them briefly, because these are all things that change, and their changes all involve cash. And so you put them all together and you can get a pretty good idea of the cash you have on hand at any point to keep the company running. The first is changes in accounts receivable. What was your accounts receivable last year? What was accounts receivable this year? So think about this for a minute. Last year, somebody owed you $500. This year, they owed you $250. So you can see that the change between the 2 years brought you in $250 more of cash. Didn't change the income statement at all, but it changes the cash flow statement, because now you have, a year ago you had a promise for $500. Now you've got cash for $250. Changes in inventory. Again, you've got it there on the books. And let's say that you had 2,000 of inventory because you're getting ready for the New Year holiday and you bought a lot of extra supplies that you hope to sell. So you spent $2,000 or whatever I mentioned there in inventory, and to your amazement, you sold 1,500 of the 2,000. Well, that 1,500 is not sitting there in your inventory now. It is cash in your pocket. And the cash flow statement says immediately, recognize that cash. You now have an inventory of 500 and you've got cash in your pocket of 1,500. So you see, these changes are not things that people can't understand. They're very common changes that make sense once you think about it. A change in a prepaid expense. Let's say you have to pay insurance In New York, I have to pay insurance once a year in September. Let's say that you have to pay 6 months ahead on your rent because you're new to the landlord and they're not sure they trust you. So they say, I want 6 months up front, which is pretty common for a new business. And then after you've been renting for a while, they say, I really can trust you. I'll give you 3 months back of your prepaid expense. So now you only have to, let's say you were renting something for $1,000 a month. So you gave them $6,000 ahead, and now they say, I'm going to give you $3,000 back of your prepaid expense because you're a good tenant. I can see that you're worth it, and so I don't need to worry about you as much. Your reward for keeping the place clean, not mistreating it, not breaking it, you get $3,000 back on your prepaid expense. That's money coming back for your pocket. So now your prepaid expense is lower, the cash in your pocket is higher. The cash flow statement immediately says, I want to know more about that. Changes in temporary investments. Let's say your company had $10,000 extra, doesn't know what to do with it, so it decides to buy shares in another company. This is very common. And so whether you buy the shares, the money goes out, you're spending the cash. Even though you're buying another company, you're still spending cash. You start getting dividends. You start getting regular payments from that company. So let's say, I guess, what did we say? You spent $10,000 on temporary investments, and now you've gotten $1,000 back in dividends. See what's happening? Now your account of temporary investments has gone down to $9,000 possibly, and you've got $1,000 in your pocket. Cash flow statement says, I want to know about that. Then we go over onto the liability side, because remember, since this is a cash flow statement, it ignores the balance sheet rules. It's mixing up assets and liabilities and saying, people, don't confuse me. It gives me a headache. I just want to know where the cash is. And so first we look at accounts payable. What are the bills you've got on your desk right now that have got to be paid probably in the next 2 weeks? The electric bill, the rent bill. These are accounts payable. You pay them, let's say that you owe $2,000 and you pay $1,500. You are now reducing your cash, and you say, well, yeah, but I no longer have a bill. They're not chasing me. That's a good thing, but that's a little different from the question that the cash flow statement is asking. They're saying, I'm looking in your pocket, and you're missing $1,500. Why did you pay those accounts payable? And you say, well, I had to. They were at the doorstep. And cash flow statement says, well, I don't care about that, but you were $1,500 poor. Changes in accrued expenses. Are there some expenses that you decide you can put off, maybe put off for 6 months? And of course, they'll send you some letters and say, you owe us this money, and you really owe this money, and we're going to come to see you, and you owe us this money. But the longer you can hold that open, that keeps the cash in your pocket, where as soon as you give it to the person who you owe money to, you're paying cash out. And that's a change in your cash flow from operations. And then the last one is one of my favorites, deferred revenue. You start out by charging somebody before you provide the service. I think I've mentioned before that Starbucks is a great example of this in the US because they pay gift cards. And we have a lot of gift cards for a lot of different companies. And basically you give them out at the holidays. And so maybe you put $10 or $50 on it, and now you've paid out the cash to Starbucks or somebody else. The cash has gone out of your pocket. Starbucks has to account for that as deferred revenue because at some point your Aunt Ina is going to come in with that gift card that you gave to her for New Year's and say, I'd like my free cups of coffee, and it's $50, I want 25 of them. Then they can earn it, they can show it on their records, but right now it's a liability, and when she claims it, they're going to have less cash. So that they're hoping that she will forget to claim it. So if you add all of these changes together, that is going to give you an idea of what your net cash from operations is. And there's a simple rule for that, and it's over on that next column, actually, and it's number 4 in the Padlet. It's column 3, number 4. If its assets calculate these changes by the last period, last year minus this year. If its liabilities and equity calculate this year minus last year. So those 2 rules in 4 and 5 tell you how to make the changes in these 7 accounts, and that is going to give you that plus depreciation plus net income gives you the amount of cash that you have to pay anything that you spend in investments or anything that you spend in financing. Now, investments, I'm not going to say too much about that. There is another video on column 4 about the stages of cash flow for different companies. Investment for growing companies is usually negative. That's why we want cash flow from operations to cover it. Because as you're growing, you need to keep buying equipment, you need to keep buying buildings, you need to keep buying a lot of assets. So the cash is going out, and you want cash from operations to be coming in. Same thing with financing. Financing can go back and forth. For example, if you use financing to pay for the investments, to pay for the fixed assets, then you're going to get some cash coming in from financing. But generally, financing is going to go out more than it comes in. And you've got to, again, have a source. The best source is, do you have cash flow from operations to meet your requirements? I'm going to stop that here and then do one more video on the cash flow from the balance sheet.